Hey there and welcome to the channel. In today's video, we are going to be discussing a company called Games Workshop, which is a $4 billion company out of the UK that makes the Warhammer figures, where you buy the figures and you paint them yourself, which is a very popular hobby for a lot of people. I am personally invested in the company, and in the video, we'll go over the fundamentals for Games Workshop and go over their latest earnings. Now, like always, we'll be using my checklist when we are checking the fundamentals of Games Workshop. And if you are interested in getting your own copy, this one is actually an older version of the checklist. I have the latest version on my website. You can check out the link in the description, but you have to go to file and make a copy to be able to edit your own edition. And by all means, if you have any items that are missing on the list, let me know in the comments so I can add it in. Now, like with most great companies, there is a write-up on them on Value Investors Club, and Games Workshop is no exception there. Although the write-up is a little bit dated, it's from 2019, but the core fundamentals of the business are still pretty much the same. So it's a really good write-up. I'd recommend, if you're interested in the company, to check it out yourself. Now, Games Workshop core business is basically in three channels, which is retail, trade, and online. And retail is mostly a one-man store, which is a clear indicator that the company is super focused on profitability. And then you have trade, which is a channel that sells their product to independent retailers, agents, and distributors. And Games Workshop also has a online channel where they are selling their figures directly through the internet, which is something that you would expect from a company in 2024. Now, after having looked at Games Workshop quite thoroughly and having been an investor in the company, I have to agree with this statement that they don't really have any direct competition because they're kind of in the middle. They're not a toy company or they're not a digital company. They're kind of a mixture of the two things. But they do have competition in the miniature world, like Privateer Priest, Fantasy Light Games, and Weird Miniatures. But I would say the biggest opportunity for the company is really in licensing their IP, and we will go further into that when we check out their latest earnings. But before we do that, I do want to show you a short clip from YouTube that explains really well how the company has been using their IP to expand the brand and make some licensing revenue.
It's kind of brilliant in a way, because if you look at all the Warhammer brand games that have come out, it appears that Games Workshop gives the really small, inconsequential licenses to studios that they aren't 100% confident in. That way, if the studio blows it, well, then Games Workshop just lets that game quietly vanish into obscurity, and their brand doesn't take that much of a hit. But if I were to wager a guess, I would bet that they tell all of those studios that if they nail it, they'll be given a meteor piece of the Warhammer license next time. And this allows Games Workshop to try studios out, embracing the successes and leaving the failures to wither without much cost. So that's what's happening with the small licenses. The medium-sized ones go to teams that Games Workshop knows can deliver, but they aren't mega studios. These mid-size licenses might be something chunky like a Space Marine chapter, but just as often there'll be some expansion or a spin-off that has its own unique feel. These are your Blood Bowls and your Vermintides. This allows Games Workshop to get a variety of products without those games competing too much with each other mechanically or thematically. And then the core licenses, 40K and Warhammer Fantasy Battle, those go to the AAA studios who are able to go big and make stuff like Total Warhammer and Dawn of War.
Going back to the checklist, there was one thing that I made a red flag on, and that was the average age of customers for Games Workshop, which I do think is a problem. And I do think with a company licensing out their IP, they are able to get a broader audience for the Warhammer hobby, which will bring in younger people, which will help the company get more revenue in the future. Now, the next thing I flagged for Games Workshop is that the company doesn't have an owner-founder or a CEO that has a large skin in the game. As we can see here, Kevin Roundtree is the CEO, and he only has £1 million invested in the company, which is 0.045%, which isn't a lot. And the rest of the management team doesn't seem to be invested either. Now, Kevin Roundtree has been buying stock in the company for the past year, but it's still not a meaningful sum. But after having gone over the financials and after reading the annual reports, I was able to conclude that Kevin Roundtree is a high quality manager, although he is what we call a hired gun. Now, the third thing that I flagged about the company is the amount they are paying out in dividend, which is quite a lot. It's not that the company isn't able to pay it out because it doesn't take a lot of money to run the company. I'm actually a little bit worried how little they are putting back into the company, which will affect future growth. And if we take a look here, we can see that the trailing 12-month numbers for the cash from operations is 259 million pounds. And they have very little in terms of capital expenditures, about 17 million. So that's about what, 242 million pounds in free cash flow. And out of those 242 million, they're paying 183 million out in dividends, which leaves them about 59 million, which they are investing back into the company. Now let's quickly run over the latest earnings for Games Workshop, which came out in January. And I just highlighted this text here from the CEO, where he's talking about the company having a cash buffer of 75 million pounds, which is in line with the current 3-month cash cost of running the company. And he talks about on a rainy day, they prefer to be able to look after themselves. And their job is to run the business under all scenarios. Now, this is something, in my opinion, that gives us a hint that the CEO is high quality. And if you read the annual reports and the half-year reports for the company, because this is a British company, so you only get half-year reports, which in my opinion is much better than getting quarterly reports. I would prefer just to get annual reports, but that's just me. You can actually see the reports from the company are very precise, they get to the point, and they are very easy to understand. If you look at the gross margin here, he is explaining how it has changed since November of 2022, where it was 64%, and he goes through all the details that are either bumping the gross margin up or dragging it down, and concludes that the margin went from 64% to 69%. And it's quite easy to read how different things have affected the overall gross margin of the company. Now, it's exactly the same thing with how cash is generated within the company, but we can see here that cash and cash equivalents were 90 million when they reported in May of 2023. And they generated 116 million pounds in cash from operations. They issued shares for 3 million. They spent 6 million on lease payments, 7 million on product development, and 6 million of purchase of capital assets, paid 15 million in tax, and 64 million in dividend, which leaves them with a cash position of 111 million. Now, I don't know about you guys, but I'm not used to getting such precise reporting from the CEOs of the companies that I'm investing in. Now, let's take a quick look at how revenue growth has been going for the company, and we can see here that core revenue grew by 11%, trade grew by 12%, and retail by 12 as well. And 81% of the stores are delivering like-for-like growth, which is good to see. And the company has already opened 14 stores in the financial year, which is from May to May. And they are planning to open 30 new stores per year. So they're not growing too fast, but they're maintaining a steady and a sustainable growth. Now, the online segment only grew by 4.9%, which is pretty slow. But the company actually opened their new online store in October. So hopefully we'll see some higher growth number when we get the next report in May. And finally, licensing revenue decreased by 2 million down to 12 million. But that revenue is very volatile and is depending on game releases and other things like that. Now, the final thing I do want to highlight is the announcement that the company made last month, where they have signed a contract with Amazon to develop the Warhammer 40k universe into films and television. And Games Workshop and Amazon will work together for the next 12 months to agree on guidelines for the films and television, which will be developed by Amazon. Now, knowing Amazon, they won't be paying Games Workshop too much money, But this is really positive for the company to broaden the customer base, especially if Amazon is able to make the TV series and films popular. Now, finally, to end this video, I want to go over the financials for Games Workshop, which are pretty impressive. And if we take a look at the free cash flow growth, we can see that it's 55% for the last year, 27% growth for the 3 years, and 25% growth for the last 5 years. Now you can also see the stability in the brand where they have a 34% CAGR on their 10-year free cash flow growth rate, which is pretty impressive. And the company is, in my opinion, not too expensive, where they are trading at 17 times enterprise value to free cash flow, and it's similar with the price to free cash flow. The company has great return on invested capital at 64%, and it seems to be pretty stable, where the 5-year median is 65%. And it is similar with the return on capital employed and return on equity. However, like I mentioned, the company is paying out a lot of the free cash flow in dividend, and for us to be able to invest in a great company, it isn't enough just to have great returns on capital. You also have to be able to put that money somewhere to use within the company, preferably. And since Games Workshop is a British company, they do prefer to pay out the extra cash in dividends, while companies in the US are more into buying back their shares. Now, if we continue with the margins, we can see that the gross margin is high and stable. It's the same thing with the operating margin, which is actually expanding. And the free cash flow margin today is very high at 36% compared to the 5-year median of 27%. Now, the company has a very healthy balance sheet where they have no long-term or short-term debts to speak of. Like most of the companies that I invest in, I really don't like to invest in companies that have a lot of debt. They have also not been diluting shareholders to any meaningful extent. And if we look at the revenue growth, it has been pretty healthy at 14% for the last year, 20% for the last 3 years, and 17% for the last 5 years. So just to conclude this video, I do think that Games Workshop is a very high quality company, and I might actually be adding to my shares very soon. The company has a $4 billion market cap, like I mentioned at the beginning of the video, which means that the company is not too small, so they are pretty stable and they have a predictable business, and they're not too big, and I believe they have a decent growth runway ahead of them. But like I mentioned with the dividend, they are paying out quite a lot at the moment, so it's going to be tougher for them to grow at a similar pace in the future. But I do think the company has a strong competitive advantage. They have high quality management and are trading at a fair price compared to their intrinsic value. And in my opinion, the future is really in licensing the IP. But I won't be making this video any longer today. I want to ask you to like and subscribe to the channel if you haven't already. Thanks for watching, and I will catch you on the next one.